What else is interesting, Rich Saperstein, and I would like to get your broader market view. You haven't been with us for a while. You are one of the country's top financial advisors. I'm curious as to just where you think we are as we end a fairly turbulent week for stocks, one in which you had many folks starting to ask, is this the long-awaited correction? Even Tom Lee, who has been as bullish as anybody, if not more so, and who is calling for a quote-unquote everything rally, says the market has taken a quote, half-empty approach to the news of late rather than a half-full, sort of, playing into where sentiment seems to be. Now, he's obviously still bullish, but what about you?
Well, sure. A very common discussion with clients. There are fears of COVID, tapering, fiscal and monetary cliff, tax reform, just a host of issues. But I like to point them to a couple other directions. The most important one is that September 6th, supplemental unemployment benefits expire. And we're going to have this complete shortfall of labor being addressed now, because every business, everywhere you go, you're seeing help wanted signs. And finally, starting in September, we'll start to see some alleviation of that, possibly putting up 500,000 to 1 million jobs a month being grown in this country. Big point. Market put up great numbers this year in terms of earnings. We expect that trend to continue. The free cash flow of the market is roughly $1.1 trillion, a record high, roughly 4%. That's still great compared to a 1.25% 10-year Treasury. The other point which supports the large FANGs is that the China crackdown on a lot of their, really solid large companies is only going to cause investments into our large cap tech companies. There'll be a rethinking of that China position in everyone's portfolio. And finally, look, the market is selling at elevated multiples. But when you look at other alternatives, and we have this discussion with our clients constantly, against the Fed tapering, we still believe that the stock market will continue to move higher, especially with EPS expectations of, let's call it 220 next year and 240 the year after.
So does that suggest that you would buy any dip? Because this was a week as well in which we had a notable technician come on our show, move the market, in fact, when he said don't buy the dip. And that was in the midst of one of the sell-offs that we experienced this week. It sounds to me like you wouldn't agree with that.
I would not. As long-term investors, we see a secular growth environment where this country and globally, we're going to have ongoing growth over the next few years. And that's going to lead to multiple expansion. The stock market today is largely dominated by technology companies. Tech is being pulled forward dramatically as a result of COVID. So if you look at the tech sector, beta in the last decade has dropped from 2 to 1. The margins are double the market. The growth of revenues of EPS is ahead of the market. So I'm comfortable with an elevated multiple as a result of 60% of the S&P being in healthcare, technology, and communications right now. So I think investors have to look around at not only the absolute level of pricing in the market, but also what are the alternatives today, and how do you rely on growth going forward? And if you rely on a growth story, then you want to own stocks, you want to buy the dips.